2010, 2011, those are some of the best times ever to buy a home in America. And I think we're going to see some similar deals this time around. So, an intelligent home buyer, an intelligent real estate investor who's looking at the data, especially for their city, they're going to be primed to take an opportunity here to get a home on the cheap. And eventually, you're right, at a mortgage rate that's cheaper today, because eventually the Fed will pivot. They always do. The question is, how bad is the economic downturn and the housing downturn going to be when they do pivot?
The housing market has been among the most frothy in recent years. In the upcoming 12 months, Zillow predicts that the annual growth in home values would reduce from its current rate of 16% to 2.4%, with some regions of the country actually experiencing a decline in home values. The areas that have experienced some of the largest valuation increases are among those predicted to experience declines during the following 12 months. According to Zillow's prediction, by July of next year, property values in San Jose, California will decline by 3.6% and those in San Francisco by 1.8%. Home builders noted ongoing concerns from rising material prices, continuing supply chain issues, and persistent inflation on second quarter results calls. As consumers, who are also feeling the effects of inflation, take a step back, the number of existing homes for sale and their prices have slowly increased. According to National Association of Realtors data from August, existing home sales declined for the sixth consecutive month in July, falling 5.9% from June. By the end of July, there were 1.3 million unsold properties on the market. Well, let's hear Nick's current assessment on the housing market.
One of the biggest fallacies and myths about the U.S. housing market, and what you got to think about again is more regionally. Like, it might be true that Los Angeles or New York City has a shortage of homes because there's dense cities that have restrictive zoning laws and it's hard to build. But it is not true at all that Austin, Texas, or Nashville, or Tampa, or many of the pandemic boom towns have a shortage. In fact, in many of these metro areas, home builders are building 30 to 40-year records of homes and apartments. So the notion of a housing shortage from a structural standpoint is not true. If you look at data comparing the relationship of employment to the number of housing units in America over the last 70 years, we're actually close to an all-time low in that metric, meaning that we have way fewer workers for how many housing units we have. Similar situation exists when you compare population to housing units. So the notion that there's a structural shortage is not true at all. It's largely one that's been pushed by housing market bulls who have a vested interest in seeing home prices go up. Home builders are in deep trouble right now. And if you look at what the home builders are saying on their earnings calls or in their sentiment surveys, it is really bad. They're having to deal with a record amount of cancellations for the last couple of years. John Burns Real Estate Consulting just reported that the home buyer cancellation rate for builders is now the same as it was in April of 2020, like that first month of the pandemic. Buyers are as scared today to buy as they were back then. Not only that, home builders are dealing also with a collapse in buyer demand in home sales. Just a report today from the U.S. Census Bureau reported a 30% year-over-year decline in home sales, up to 50% on the West Coast of America. And so look at what these home builders are doing and saying. Their sentiment has collapsed, their reported buyer traffic has collapsed, and now they're very open about saying this. The National Association of Home Builders just said that we're in a housing recession. They're going on record saying that we're in a housing recession. In fact, so is the National Association of Realtors. So these big entities are starting to come around to the idea that the housing market crash has started.
Housing market index is flashing strong signals of a housing slowdown. In September, single-family home builders' confidence dropped for the ninth consecutive month as rising mortgage rates and stubbornly high building material costs made new homes less accessible to many first-time purchasers. The N.A.H.B housing market index fell 3 points this month to 46. Since May 2014, this rating has been the lowest. A number below 50 implies that more builders consider the situation to be poor as opposed to favorable. Privately owned residential starts in August were at a seasonally adjusted annual rate of 1.5 million. This is 12.2% above the revised July estimate of 1.4 million. And single-family in August were at a rate of 9.3 million. This is 3.4% above the revised July figure of 9 million.
So we had artificially low interest rates and mortgage rates, not just during the pandemic, for the last 10 years. And that enticed a lot of people to buy into the housing market because even though the prices were going up, their payments were low. But now that mortgage rates have surged to actually a more historically normal level, that's meant that over the last year, the typical home buyer mortgage payment's gone up by something like 50% year over year, whereas the average wage in America has only gone up by about 5.5%. So you're right, it's simple math. home buyers can't afford the cost of a house, either on the down payment and the price or on the ongoing mortgage payment. And some very concerning statistics I'm seeing now suggest that the quality of loans being issued in the housing market over the last couple of years is starting to approach the kind of poor level of quality in 05, 06, 07. When I look at the metrics, yes. And this is something that is going to be controversial for me to say, because the mainstream narrative on this is saying there's only good loans in the US housing market. But when you look at data from Fannie Mae and look at what's called the debt to income ratio, basically measures what's the mortgage payment and how much are the borrower debt service payments as a relationship to income. That debt to income ratio now is as high as it was in 06, 07 at the peak of the last housing, suggesting that borrowers today are just as strapped in their ability or inability to afford the monthly mortgage payments. And so this is something that I think is going to cause foreclosures to surge over the next couple of years, which is going to, of course, make the housing crash even worse. It's an interesting question. I think you might be right, especially if the inflationary environment persists. The Fed's likely going to continue hiking interest rates. But altogether, I actually don't think it matters that much. I mean, on one hand, yes, you're right. The surge in mortgage rates has priced many borrowers out of the market, but I want to actually spin it a different way. Now that we're entering a declining home price environment, right? Think about a buyer. The FOMO of the last couple of years is now gone because prices are starting to go down. So the buyer can say to themselves, well, I'm going to wait to buy now. Layer on, what if there's a perception that mortgage rates are going to go down into the future? Now, all of a sudden, a borrower or a buyer would say, okay, so now prices are going down and maybe mortgage rates are going to go down into the future. Well, then why would I have any incentive to buy today? Because if I buy in a year, I'm going to get a better deal. And so either way, with whatever happens with mortgage rates, say they go up another 50 basis points or say they go down 50 basis points, I actually don't think it's going to impact home buyer demand that much. Meaning that home buyer demand is going to continue to stay near 10-year low levels as long as this housing downturn continues, and as long as this economic recession continues. And that's exactly what happened in the last housing crash. I mean, 2010, 2011, those are some of the best times ever to buy a home in America. And I think we're going to see some similar deals this time around. So, an intelligent home buyer, an intelligent real estate investor who's looking at the data, especially for their city, they're going to be primed to take an opportunity here to get a home on the cheap. And eventually, you're right, at a mortgage rate that's cheaper today, because eventually the Fed will pivot. They always do. The question is, how bad is the economic downturn and the housing downturn going to be when they do pivot?
The Fed's relentless tightening of monetary policy has significantly affected the housing market. The benchmark 30-year fixed mortgage's current average rate is 6.33%, up 23 basis points from this time last week. That is a huge drop in purchasing power for the nearly 75% of American homebuyers who use mortgage finance. Home prices will need to decline significantly unless incomes increase or mortgage rates decrease. Thank you so much for watching till the end. If you find this video useful, please like, share, comment, and subscribe to help this channel.